8 weeks. That's not a typo. That's the delivery weight some big buyers are being quoted right now in London for large silver orders, inside a market that's supposed to move metal basically overnight. Trade today, settle tomorrow. T+1, simple, clean, efficient. So when someone tells you, yeah, come back in 2 months, it's not a shipping problem, it's a signal. And if you understand what that signal really means, you'll see why the silver market may be closer to a hard break in price discovery than most people realize. In the next few minutes, I'm going to walk you through exactly what happened, why it matters, what the paper market is trying to hide, and what clues are already leaking out through lease rates, delivery delays, and the growing gap between East and West pricing. Stick with me, because near the end, I'll explain the one scenario that could force a disorderly move, the kind of move that doesn't give you time to get ready. Now, quickly, before we go deeper, I'm running a campaign to take a stand against copycat channels that rip creators off and recycle content like it's a factory line. If you get value from my work and you want to support original content, hit subscribe and drop a quick comment that says, OG John AG. That one small action helps more than you think. Also, if you want daily videos, quick posts, my personal breakdowns, and instant updates I don't always put on YouTube, I set up a WhatsApp channel and community. It's more direct, more raw, and sometimes I even drop quick voice notes when something important hits. The link is in the description. Join it, because when these moves start, speed matters. All right, let's get into what's really going on. Here's the official story being whispered around. London is backed up. There aren't enough trucks, not enough manpower, not enough logistics. So deliveries are delayed. 8 weeks. Please be patient. And I'm going to say it the way it needs to be said. That excuse doesn't pass the smell test. London isn't supposed to operate like a slow-moving retail supply chain. London is the heartbeat of the global bullion system. It's where massive trades clear, where bars are allocated, where settlement is expected to be fast and predictable. If that system is telling institutional buyers, we can't get you your metal, then the first question is not, where are the trucks? The first question is, where's the metal? Because in a real T+1 environment, the metal should already be sitting in a vault, already part of the settlement process. It isn't supposed to be mined after you click buy. The deal happens because the inventory is presumed to exist and be deliverable. So when the deliverable timeline stretches from 1 day to 8 weeks, that's not friction. That's a structural stress fracture. And here's where it gets interesting. The stress isn't showing up the way most people expect. It's not screaming at you through the spot price on your screen. It's not flashing red lights on the chart. It's showing up in the plumbing, borrowing costs, leasing rates, settlement delays, spreads, premiums. Quiet, technical stuff that mainstream headlines almost never explain properly. And that's exactly why it matters. Because by the time the mainstream catches on, the move is usually already underway. Let's talk about lease rates for a second, because this is one of those boring terms that becomes very exciting when it spikes. A lease rate is basically the cost to borrow metal for a period of time. If you're a participant in the bullion ecosystem, maybe you need to deliver against a contract, maybe you need inventory for fabrication, maybe you need to bridge a timing gap, you can lease silver instead of buying it outright. In calm markets, leasing silver is cheap. It's like borrowing a ladder from your neighbor. You return it. Everyone's happy. The cost is tiny. Historically, those lease rates sit under 1%, sub 1, sometimes even near 0, because the assumption is silver is available, the market is liquid. You can borrow, you can return, no drama. But when lease rates jump to 7%, 8%, 9%, when they spike into the double digits, when they temporarily blow out toward levels that belong in a credit crisis, that's the market whispering something very specific. I'm not confident I can get this back. And that's the key. High lease rates aren't about greed. They're about risk. The lender is saying, if I hand you my metal today, I want to be paid like it's dangerous. Now ask yourself, why would leasing become dangerous in a market that claims to have hundreds of millions of ounces sitting in vaults? This is where the story goes from delay to deficit. Because the deeper claim, coming from people close enough to see the mechanics, is that a lot of the metal sitting in those vaults is not actually available for sale. It's there, but it's spoken for. It's already owned, already pledged, already tied up inside ETFs, funds, long-term holdings, and internal bookkeeping structures that make it look like inventory while functioning like it's off limits. So you end up with two categories of metal. Metal that exists, and metal that exists and is actually deliverable. Those are not the same thing. And when the market starts leaning hard on that difference, the paper price on a screen becomes less important than the real-world ability to deliver bars. That's why the 8-week delay matters. It's the market admitting, in its own awkward way, that the for-sale pile is getting thinner. Now, I want you to think about how leverage works here, because this is where people get lost. In paper markets, you can create exposure without moving the underlying asset. You can write contracts, you can trade claims, you can net positions, you can settle in cash, you can roll. And as long as most participants are playing the same game, buying and selling paper claims, price discovery is dominated by paper flows. But the moment enough participants say, "No, I want the real thing," deliver it, the game changes. Because paper can be infinite. It can be printed. It can be rehypothecated. It can be layered. Physical can't. Physical has to exist in a specific form, in a specific place, at a specific time, in a specific chain of custody, with a specific bar list. And when physical demand collides with a paper-dominated pricing system, the first cracks show up exactly where we're seeing them: delivery delays and elevated borrowing costs. Now, there's a second signal I want you to watch, and it's one that makes a lot of people uncomfortable because it challenges the idea that the screen price is the truth. That signal is the growing premium in Eastern physical markets, especially when a major exchange in Asia consistently prices silver above Western spot and futures pricing. Because what is that, really? That is a physical ecosystem saying, your paper price does not reflect what the metal is worth where it is actually being used. And why would that happen? Because those physical markets are closer to end users, closer to industrial demand, closer to fabrication, closer to real delivery. The metal is moving through hands that need it for actual production. Whereas Western pricing, much of it, sits inside future structures, leverage, and financial positioning that can drift away from physical conditions for a long time. So you get two worlds. One world discovers price through paper, the other discovers price through delivery, and the spread between them is what happens when those worlds stop agreeing. At first, the spread looks like a weird anomaly, a rounding error, a short-lived dislocation. But if it persists, and especially if it widens, it starts to function like a scoreboard. It tells you which side has the stronger grip on reality. And if the physical side keeps paying more, it's essentially voting with money. We don't care what your screen says. We're paying what it takes to get metal. Now, I'm going to slow down here because this next point is where the entire narrative can flip. If the West continues to price silver primarily through leveraged claims, but the East keeps pulling physical into real-world use, the tug of war ends the moment the West can't deliver on time. That's the moment the paper price loses authority. Not because someone announces it, not because a headline admits it, because the real economy simply refuses to accept the paper price as the true price. And when that happens, price discovery doesn't adjust. It snaps. It moves violently because the system has been stretched like an elastic band for years, and when it breaks, it doesn't break politely. Now, you might be thinking, okay, John, but isn't there still a ton of silver sitting in London vaults? Don't the reports show huge numbers? Yes, reports show big numbers. But here's the trick. Reported inventory is not the same as available inventory. Imagine a parking lot full of cars. Looks like a massive supply, but if every car has an owner and none of them are selling, you don't have supply. You have a display. And if a dealer tries to fulfill orders from that parking lot, they'll find out fast. Most of those cars are not for sale at any price the dealer wants to pay. That's what encumbered metal is. Metal that exists on paper as inventory, but is tied up by claims, ownership, or structures that make it effectively unavailable. So the idea of free float becomes everything. How much is truly for sale? How much can be delivered right now? How much is unspoken collateral for someone else's strategy? And the fact that big buyers are being pushed into 8-week timelines suggests the free float is not as free as advertised. Now let's add a third layer to this, because the story doesn't stop in London. There's also tightening on the supply side out of Asia, specifically in the way exports are being controlled. If you haven't been watching this, here's what matters. When a major refining and export hub shifts policy from export freely to export through approved lanes only, and then quietly signals that domestic demand takes priority, it introduces friction and risk into the global pipeline. It's like narrowing a highway from 5 lanes to 1 lane and then acting surprised when traffic piles up. And here's the part most people miss. Even if the total global silver supply doesn't collapse overnight, the ability to move silver from where it sits to where it's needed can become constrained. Paper markets hate constraints because constraints reveal shortages. Constraints expose who is naked. Constraints force bids to rise. So when export rules get tighter, licensing gets slower, paperwork gets heavier, and authorities gain the ability to slow things down whenever they want, you're not just looking at bureaucracy, you're looking at a strategic lever. And if that lever is pulled at the same time, Western vaults are experiencing delivery strain, you get a double pressure event: pressure from demand, pressure from supply. That's when the calm chart becomes a liar, because the chart is the last thing to admit what the plumbing already knows. Now, I promised you cliffhangers, so here's one. If you want to know whether we're close to a real break, Watch what happens next with lease rates. If lease rates fall back down and delivery times normalize, then the system found enough confidence to relax. But if lease rates stay elevated, if delivery timelines stay long, if the east-west spread stays wide, then we are watching the physical market override the paper market in slow motion. And the next phase, after slow motion, is fast motion. Here's another cliffhanger. The most dangerous moment in a stressed commodity market is not when everyone is panicking. It's when only a few people realize there's a problem. Because in that window, the smart money is positioning quietly, the mainstream is asleep, and retail is being distracted by whatever headline is trending. And then, one day, it becomes obvious. Not to you, not to me, not to the big players. And once they decide, collectively, that delivery risk is real, the scramble is immediate, because nobody wants to be the last person holding a paper claim when the market starts demanding bars. Now, I want to connect this to your reality as a viewer, because this isn't just theory. If you are someone who buys physical silver, even occasionally, you need to understand the difference between price and availability. In normal times, price leads and availability follows. In stressed times, availability leads and price chases, and 8-week delays are availability screaming. Now let me address something I know some people will say in the comments. John, maybe this really is just a logistics issue. Okay, let's play that game. If it's logistics, then why are borrowing costs spiking? If it's logistics, then why are premiums widening in physical markets elsewhere? And if it's logistics, why does it only seem to matter at scale? For big buyers who try to pull real metal out of the system, small purchases can be filled from many channels. Large purchases expose the depth of the pool. A kiddie pool looks huge if you're holding a teaspoon, but if you back a truck up and try to drain it, you find out real quick how much water is actually there. That's why institutional delivery delays are the canary in the coal mine. They stress test the system. Now, let me paint you a picture of how this usually works when everything is normal, because that contrast is what makes the current situation so loud. An institution calls in a request. They want size. Not a few coins, not a couple of bars, size. They're not shopping for a souvenir. They're trying to secure inventory at scale. They do the deal, and in a functioning settlement system, the next day, the paperwork becomes metal movement. Bars are allocated. Vault instructions go out. The right bars get tagged to the right owner. Metal is either transferred within a vault system or moved across vaults with logistics that are routine because this market has been doing it forever. That's why the "we can't find trucks" line is so weak. This industry is literally built around moving heavy metal safely, predictably, every day. They don't improvise it once a year like a small business shipping a pallet. It's the core function. So if delivery time suddenly stretches to weeks, here's what that implies. Either the bars are not where the paperwork says they are, or the bars are where the paperwork says they are, but they are not available to be handed over, or the bars are being used as collateral and the system needs time to unwind positions before it can let the metal go. And that third point is where people's eyes usually open. Because a lot of the modern bullion ecosystem isn't built like a simple warehouse, it's built like a balance sheet. Metal can be held in allocated form, meaning specific bars are set aside in your name with clear ownership. Or it can be held in unallocated form, meaning you have a claim, a promise, an IOU. You're exposed to price, but you may not have immediate claim on a specific bar. Unallocated is popular because it's convenient, it's flexible, it's liquid, it's efficient. But unallocated is also where leverage hides. Because if 10 people have paper claims that can be netted and rolled, the system can operate with far less physical metal moving than the paper volume suggests. Again, paper can be layered, physical can't. Now, when an institution shows up and says, convert that exposure into allocated bars and deliver, they're basically pulling a thread. If the thread is attached to real inventory, the system shrugs and delivers. If the thread is attached to a network of claims, swaps, leases, and internal promises, the system needs time. And time is exactly what they're asking for when they say 8 weeks. So, in my mind, the delay itself is the admission. The delay says, we need time to source, shuffle, and resolve. And here's where the story gets more intense. When the system is under stress, it tries to discourage behavior that worsens the stress. How do you discourage people from demanding delivery? You make it feel inconvenient. You add friction. You add waiting. You add paperwork. You add reasons. Not because the reasons are true in a pure sense, but because the reasons create hesitation. And hesitation is how the paper system survives. Now, I want to talk about something that's easy to miss. The difference between inventory and float. Inventory is everything in the building. Float is what can actually trade. If you run a grocery store, you have inventory in the back, in the freezer, on the shelf. But not all of it can be sold right now. Some of it is reserved for tomorrow. Some of it is earmarked for a contract. Some of it is in the wrong form. Some of it is simply not for sale. So when someone tells you there are hundreds of millions of ounces in a vault system, the only question that matters is how much can actually be delivered quickly without breaking another promise. That's why the idea of free float becomes so important. Locked metal doesn't solve delivery. And when serious observers say they suspect the free float is smaller than advertised, they're describing a structure where visible metal can be effectively locked by ownership, custody, and collateral. Now, here's a test you can use to evaluate whether the market is tight without even looking at a single headline. Ask, where does stress show up first? In metals, it often shows up first in borrowing costs, because the system tries to borrow its way through shortages before it reprices. If a participant is short metal, meaning they owe delivery, they have two options. Option 1, go into the market and buy metal immediately. That pushes price up and broadcasts the problem. Option 2, borrow metal, deliver it, and hope the problem resolves later. That keeps price calmer and keeps the issue quieter, so the system prefers borrowing first, which means lease rates become the early warning system. And that's exactly why the lease rate spike is such a big deal. Now, there's another early warning signal that ties directly into London. Trust. When markets are healthy, trust is cheap. Settlement is routine. When markets get tight, trust gets expensive. People want guarantees. They want allocated metal. They want shorter terms. They want better collateral. That shift is mostly invisible to retail, but it's everything to insiders. So when you hear about longer settlement times, higher lease rates, and delivery delays, you're hearing about trust changing shape. And trust changing shape is a precursor to repricing. Now, let's bring the East back into this. When you see Asian physical pricing staying above Western paper pricing, it's not just a gap, it's a message. It's the physical market saying, we are not selling at your paper-derived price. And that message becomes stronger when the physical market is tied to real industrial demand. Industrial demand doesn't negotiate with charts. It negotiates with procurement reality. If a manufacturer needs silver as an input, they'll pay what they must to keep production flowing. And when enough real-world buyers pay premiums consistently, they create a new reference point for value. That's how paper loses authority. Now, let's connect this to the supply pipeline, because the pipeline is getting more controlled. And when export lanes tighten, when exporters are limited, when additional licensing is required, when domestic priority is emphasized, global supply becomes less responsive. So if demand spikes, supply cannot ramp quickly, and when supply cannot ramp quickly, price becomes the balancing mechanism. But again, the system may try to delay before it reprices, and that's what we're witnessing. Delays. Now, I want to highlight a phrase you should never ignore in metals. Cash settlement. Cash settlement is fine when you wanted a cash bet. It is not fine when you expected metal. It's Plan B, and Plan B exists for a reason. So when you see delivery delays, understand what the system is trying to avoid. It wants to avoid repricing. It wants to avoid public loss of confidence. It wants to avoid pushing people from paper into possession. Delays buy time to prevent those outcomes. Now, before we go further, I want to pull you into the conversation again. Have you personally experienced longer than normal delivery times when buying silver lately? And second question, do you think the real break, if it comes, shows up first in price or first in premiums and availability? Drop your thoughts in the comments. I read them, and you'd be surprised how often the crowd spots patterns before the headlines do. And speaking of the comments, friendly reminder, if you're doing well right now, if you've had a win, if you've built something, if you've improved your finances, share a line or two down there, not to flex, to motivate. Now, I'm going to give you a set of red flags to watch, and this is where the cliffhanger pattern starts to feel real. Red flag number 1, lease rates spike again, especially if they jump sharply for short maturities. That suggests immediate tightness. Red flag number 2, delivery times widen further. If 8 weeks becomes 10, then 12, then unknown, that's rationing. Red flag number 3, persistent premiums in Asia that don't close. If the gap becomes a feature, physical is in charge. Red flag number 4, policy tightening around export lanes. If domestic supply is prioritized harder, the risk premium rises. Now, I can already hear someone saying, John, maybe this is a short-term bottleneck. Maybe. And that's why we watch the indicators. Short-term bottlenecks resolve quickly. Structural stress persists and deepens. So here's what I'm doing. I'm not guessing. I'm watching the signals that are hard to spin, because narratives can be spun, charts can be cherry-picked, but borrowing costs and delivery timelines are stubborn. Now, here's a viewer-style question that always comes up. If this is true, why hasn't price already exploded? And the answer is, because the paper system can absorb pressure for a long time, until it can't. The system is designed to delay repricing. It has tools. It has role structures. It has cash settlement options. It has margin tools. So the absence of an immediate explosion is not evidence that nothing is wrong. It's evidence that the system is still containing pressure. And when containment fails, the move can be sudden. Now, another viewer question. What's the one moment you're watching for? The moment I'm watching for is when large participants stop accepting delays. When the market says 8 weeks and the buyer says no, now. When enough buyers do that, price discovery is forced to happen in public because the market will have to offer a price that pulls metal out of hiding. And metal does hide inside long-term holdings and not for sale hands. Price is what brings it out. Now, as we move toward the close, I want to give you a practical framework. Don't fall in love with a single indicator. One indicator can be noise, 2 indicators can be coincidence, 3 indicators can be a pattern. Right now we have a pattern. Delivery delays, higher borrowing costs, regional physical premiums, and tighter export lanes. That's why this matters. Now, final cliffhanger, and this is the one I want you to remember. If the physical market keeps tightening, the moment price discovery flips won't be announced. It will be felt. It will be the day someone tries to get metal and the answer isn't 8 weeks, it's no. And when no hits the wrong participant at the wrong time, the scramble starts. And scrambles don't end with small moves, they end with repricing. That's why we're talking today, not when it's obvious, today. Now, let's zoom in on the export side a little more because this is where a quiet policy move can turn a tight market into a panic market without warning. When export permissions are narrowed, when only approved companies can ship out, and when additional licensing steps get added, the effect is not just less supply, the effect is slower supply. And slower supply is brutal in a market that prices itself as if metal can appear instantly. Think about it, like a restaurant during peak hours. If the kitchen slows down by 20%, the menu doesn't change, the lights don't flicker, and from the outside, everything looks fine. But the wait time doubles. People get angry, people leave, people complain, and the moment the crowd realizes the kitchen can't keep up, the vibe changes fast. That's what supply friction does in commodities. Now add a second layer, domestic prioritization. If authorities signal, even quietly, that domestic demand takes precedence, exporters don't just ship less. They become cautious. They hold back. They wait for clearer direction. They protect their local relationships. And that hold-back behavior tightens the global flow even more. This is why I keep saying, don't get hypnotized by global mine supply numbers. Flow matters. Timing matters. Permission matters. Now, let's connect that back to London. If London is already stretching settlement and the export pipeline becomes less flexible, you remove the easiest escape hatch. You remove the we'll just pull metal from somewhere else option. And that's when premiums can rise even if spot price hasn't moved yet. Because spot price is the price of confidence. Premium is the price of urgency. Now here's another retention punch. The market can live with higher prices. What it can't live with is uncertainty about delivery. That's why industrial buyers behave differently than speculators. A speculator can wait. An end user often can't. So if end users begin paying up, the physical floor rises and paper eventually follows. Now, I want to be very clear. This doesn't mean every day is the day. It means the setup is becoming more sensitive to shocks. And in sensitive setups, even a small surprise can create a big move. A shipping delay here, a policy update there, a sudden rush of buying into allocated metal, a jump in lease rates. Each one by itself might look manageable. But the combination is how systems break. Now here's the part I want you to keep in your head when you look at a calm chart. The chart is the last place stress shows up. The first place stress shows up is behind the scenes. Settlement terms, borrowing costs, and sorry, come back later. So don't let a calm price lull you to sleep. Now, quick and honest moment. A lot of you watch every week, but you haven't subscribed yet. If this channel helps you see what others miss, support it. Hit subscribe. It tells YouTube to push this to more people who need it instead of pushing recycled content. And again, if you're with me on keeping original work visible, comment OG John AG. Simple. All right, let's land this. If you only remember one thing from this whole breakdown, remember this. A T+1 market quoting 8-week delivery is not normal. It's a warning, and warnings are most valuable before the event, not after. So keep your eyes on the plumbing, keep your head out of the hype, and keep your attention on the signals that are hardest to fake. And one more thing before we roll back into the main script. Watch how often the market tries to distract you. When physical stress rises, you'll suddenly see a flood of nothing to see here narratives. You'll see people tell you silver is dead money. You'll see people mock shortages as internet rumors. You'll see confident voices say, if there was a problem, price would already show it. But that's the point. The whole design of a paper-driven system is to keep price from showing it until the last possible moment. So when you see delays, and you see lease rates, and you see premiums, don't let someone on a screen gaslight you into ignoring your own common sense. because common sense says if it's hard to get, it's scarce. And if it's scarce, it eventually costs more. Now, back to the story, because the next part is where things get even more revealing. Oh, and if you're wondering what would confirm this shift for me in a single headline, it would be a major institution openly admitting extended delivery schedules as standard, not temporary. The moment temporary becomes normal, the market has changed. And once the market changes, it rarely changes back quietly. That's why we're watching the language as much as we're watching the numbers. Stay alert, calm, and ready. Now, let's talk about what price discovery really means in this context, because people throw that phrase around like it's a buzzword. Price discovery is the process of finding the true price where willing buyers and willing sellers meet. But in a heavily leveraged paper environment, price discovery can be distorted because sellers can sell claims, not metal, and buyers can buy exposure, not bars. That works until somebody demands reality. And when reality is demanded, the true price is discovered not on a screen, but through the cost and difficulty of obtaining the real asset. So when the physical market starts saying silver is worth more than your spot price, it's not because they're emotional, it's because they're solving a real problem. How do I secure supply? Now, I want to give you a simple mental model for what may happen next, and I'll keep it grounded. Phase 1, plumbing stress. That's what we're seeing. Lease rates higher, delays longer, spreads wider. Phase 2, recognition. More participants realize delivery risk is real. They start shifting from paper to physical. They begin paying up for certainty. Phase 3, repricing. The paper market is forced to adjust because the physical market is no longer willing to sell at paper-derived prices. Phase 4, disorder. This is the part nobody likes because it can involve sudden gaps, chaotic moves, and rule changes. Now, right here in the middle of the video, I want to do something quick. If you want to hear real silver-related success stories, people who actually took action, stayed consistent, and built wealth over time, there's a separate channel I recommend where those stories are shared in a clean, focused way. The link is in the description. Check it out and subscribe. All right, back to London. Let's zoom in on the T+1 issue because this detail is important. T+1 means the trade is executed on day T and settlement occurs one business day later. So if an institution buys, the presumption is the seller has access to deliverable bars or can source them within that settlement window. If the seller cannot, the market usually does one of two things. Either it reprices, meaning the cost to get immediate metal rises, or it delays, meaning the market tries to buy time to avoid repricing. Now, which one is better for a paper-dominant system? Delay. Because repricing admits the truth in public. Delay buys time, creates confusion, and keeps the screen price looking stable, and that's why delays can be more revealing than price moves. A chart can be managed. A delivery schedule is harder to fake. Now, I want to take you through a what-if scenario you should understand. What if a large number of participants decide they don't want exposure anymore? They want possession? That means they start converting unallocated holdings into allocated bars. They request delivery. They move metal into private custody. What happens? Available inventory shrinks. Delivery timelines lengthen. Lease rates rise. Premiums increase. And eventually, the paper market is forced to reprice to retain metal. That repricing can be sudden. Now, another what if. What if the spread between an Asian physical price and a Western paper price stays wide long enough that arbitrage becomes difficult? Normally, arbitrage would close the gap. Buy cheap here, sell expensive there, move metal, profit, gap closes. But if moving metal takes weeks, if export controls slow flow, if vault availability is constrained, then arbitrage is no longer easy. And when arbitrage fails, spreads can persist. And persistent spreads are an alarm bell. Now, you're probably thinking, okay, John, what should I do with this information? I'm not here to give you personal financial advice, but I can tell you what to watch and how to think. Watch leasing rates, watch delivery lead times, watch regional premiums, watch how often logistics excuses show up, and most importantly, watch how the story is framed. If mainstream outlets start talking about unexpected silver tightness after months of ignoring these signals, it may mean the recognition phase has begun. Now, I need to weave in the membership piece because a lot of you ask me for one place where everything is summarized. By the time you're watching this, there should already be a members-only video live that pulls together the latest updates into one clean breakdown. If you want the deeper, more in-depth analysis, join the membership and watch that members video. It's also a way for me to see who's really following consistently. Now, let's hit one more engagement point. If you've ever bought silver and felt like the price didn't match the reality of what dealers were charging, premiums, shipping, delays, share what you observed in the comments. Those details are valuable. In the comments, tell me whether you prefer paper exposure or physical possession, and what you think the next excuse will be if London delays keep dragging on. Drop that below. And if you're successful, If you've made progress, built a business, stacked consistently, or just improved your life, share a quick line down there too. Your story could be the reason someone else keeps going. We're watching a major shift unfold, not in headlines, but in the mechanics of the market. Lease rates, delays, spreads, export controls. These are early tremors, so stay sharp. Subscribe so you don't miss the next update. Join the WhatsApp channel for instant posts and voice notes. And remember, if you value original work, comment OG John AG. And if you're still here, you're the core of this community. Respect. Take care of yourself, take care of your people, and I'll see you in the next one.